switch gears a little bit now, and I'm going to talk about the money portion, because this oftentimes is a question that people bring up, and I think it's good to know just in case you ever decide you want to be an entrepreneur, or just because you want to know the general financial health of the company that you're working at, right? So the first question that comes up is, kind of what's the difference between this funded startup versus a company that's not funded? Well, I'm going to call this two variations. There's funded, which is either backed by angel investors or venture capitalists, and then there are bootstrapped businesses. So let's start with bootstrapped. When I say a company is bootstrapped, I basically mean that they haven't taken any outside capital from angels or venture capitalists or from investment bankers. They will have finances based on a few different factors. The first is the founder may just be making withdrawals from their personal bank account. The founder might be working part-time or full-time and using their paycheck. Or the founder or the company might actually have revenue. And that revenue could be coming directly from the product, or they might have some services. They might do some consulting. They might be building something for some clients, right? So there are these different hybrids, but ultimately, bootstrap means that they haven't taken in outside capital, and they're pretty much self-sustaining themselves, and they're reinvesting the money that they make back into the company. Now, when I say this does not mean that these companies are poor. This does not mean that these companies cannot pay market rate. In fact, I've met a number of bootstrapped companies who have bootstrapped their way to hundreds of millions of dollars in revenue. So it is possible. Takes a little bit of a longer trajectory, usually like, 5, 7, 10 years, 15 years, but they do exist. And in the market today, it seems like it's getting even shorter in terms of time span. The beauty of a bootstrapped startup is that the founders have a lot of say. This doesn't mean that they're micromanagers. This means that they get to direct the vision of the company, right? They have the majority stake in the company. They've mostly been thriving off of revenues. And so as a result, they get to do some of the things that they want. They get to set their own culture. They get to direct the product. And they get to build the kind of company that they want to build. So a lot of times, this can be a great type of startup for you to join. So don't discount these. The other is, given that it's bootstrapped, they're making money, right? This means that they're self-sustainable. They don't have to constantly, worry about when their next financing round is going to come up. But they've obviously got to have a good recurring, stream so that they know that they're going to be sustainable, right? So keep that in mind. Don't discount them. Now, contrast that to a funded startup. Now, like I said, there are two kinds of funded. There are startups that have been funded through angel investment. An angel is basically someone who has a very high net worth, and they want to be able to invest their own personal assets. So they write a check. They write checks anywhere from $500,000 to $1 million. It kind of just depends. And then there are venture capitalists, right? Venture capitalists are basically investing other people's money, and they invest anywhere from $500,000 to hundreds of millions. Depends on the type of business. Now, the difference between these is usually angels come in very early on, so you may come across some early stage companies that have received what's known as a seed round of funding, a small amount, and depending on the type of startup, it could be $500,000 to several million. If they're venture backed, then it's usually not necessarily early stage, but there are always a few that VCs back early on, so you can keep that in mind, but typically it's in those later stages. Now, the key differentiator that I have noticed is that in these bootstrapped companies versus these funded companies, the pace is just a little bit different, right? The reason the pace is a little bit different is because in a funded company, there is a very clear time horizon. That time horizon is within 5 to 7 years, there needs to be some sort of liquidity event. People have put in money, they expect to get money out. And that liquidity event, I'll tell you a little bit more about what that means, but that has to come in the form of something like an acquisition or an IPO, right? People want to get back their initial investment. So that means a lot of funded companies operate at just a slightly faster cadence than bootstrap companies. Doesn't mean bootstrap companies are slow, but oftentimes funded are just a little bit faster. So I often joke that if you want to get on a rocket ship and go fast, then go look for a funded company, right? There are a number of people that want to have that, and that's fine. I'm not saying every funded company is super fast, but in general, in aggregate, they tend to work a little bit faster. They've got milestones, they have board meetings, there's a lot of accountability because they have raised that capital. In a bootstrap company, a lot of times people don't need to have that liquidity, well, they don't even have to have that liquidity event, it's up to the founders, but most often, they're waiting for that exit much farther down the line, or a lot of times they actually reinvest back into the company, so they pay out profits or dividends to their employees. So, I think Heather and her team summed it up pretty well when they said that the team is what matters the most, right? So, keep that in mind, right? These things like funding, the type of product also matters, but don't let funding and things like that dissuade you from joining a startup. Take the time to understand whether the team that is in front of you is one that you can jive with, right? Because in those early stages, you don't know how long the company is going to go. It could be 1 year, it could be 5 years, it could be 10 years, it could be 20, right? So if you want to get a sense of whether you can grow with this company, invest in figuring out whether you like the team and the way that they operate.